before we go into that, you all you've been seeing that we've started test already. Started on Monday, and I believe you have been seeing the links and the question bank on your platform. Please ensure you take your test as at when due. So if it happens that you have not taken any one since on Monday up till now, the door is still open for you to write any of those tests from Monday up till Friday. You can still write it, right? Because by Monday, we are going to disable all those links. So please, if you have not done any of your tests, do well to do that. Like it was said, this is one of the criteria for your graduation and to get your certificate. So please do well to complete all of your tests. Thank you so much. So without further waste of time, we are going to go into the business of today, fill up the attendance in the chat room, and then we can take it off from there. Thank you so much. The person who will be handling today's class is none other than Esther Osilama. Ma'am, please, if you can hear me, the floor is yours. You can take it off from here.
Okay. Good morning, everyone. Good morning, Messi. Good morning, everyone on the call, and thank you very much for the opportunity to facilitate today's session. I do not take it for granted at all. So just like Messi had said earlier, we are going to be looking at forms of business ownership. So please just give me a second to share my screen. Okay. Please let me know when my screen is off.
Yes, we can see your screen. Please, can you put it in a projection mode?
Okay. Is it better?
Yes, it is. Thank you.
Okay. Thank you very much. Okay, so today we'll be looking at forms of business ownership. And I don't believe that this topic is strange or new. Is a topic that every one of us on the call must have heard. We have studied it, whether formally or informally. So it is a topic that every one of us is quite acquainted with. But today we will just be looking at some of the business ownership that is prevalent in today's economy. And so I said, welcome to this session. Again, every one of us, you're welcome. Today we'll be looking at the business structures, how it shapes responsibilities and growth opportunities. So today's session is going to help us make informed decision when you want to start or manage a business. So we're going to be looking at forms of business ownership. So you would also agree with me that it is very important that we understand the kind of business ownership, the kind of business we want to run as relates to its forms of ownership. How do you want it to be run? How do you want to control it? Are you looking at having a couple of persons running the business concurrently, or you just want it to be just myself, just yourself alone? Or do you want it to be a registered company that is going to have to follow some of government regulations? This and many more are what we are going to be looking at in today's session. So we have a list of contents that we are going to be looking at. The first one, we need to understand what business really means, business concept, and the framework of business before we now talk about the ownership. So we cannot just jump into ownership of business when we don't even understand what business itself means. So we'll look at the foundations, then the type of ownership, the business functions, what exactly is expected of employees, of the departments, the different stakeholders in the business, and also external forces. We are going to be looking at these and also some special topics like franchising, mergers and acquisition, very special forms of business ownership. So we are moving in very fast. And before we see what is business, we just have a very quick activity, and I want each and every one of us to participate. And I'm saying, let's start with you. Let's start with us. Let's start with everyone on the call before we now talk about what business exactly means. So just imagine this is an imaginative call now. I'm asking us to use our minds. You are imagining that you were given $1 million. Initially, I used 1 million naira, but I discovered that it's not just Nigerians that are on the call, and I had to use $1 million. It might sound like it's big, one ridiculous amount of money, but just follow me. So imagine you receive $1 million today. What business would you start? And which form of ownership would you choose? Are you going to consider the following factors? Because you really need to. The first factor is, what risks are you comfortable with? Are you comfortable with the risks that is associated with a one-man business? Are you comfortable with the risks that is associated with partnership and the others? Do you have the skills to go solo? Do you have the skills? So I'm trying to make us paint a mental picture of what we are going to be doing if we are giving $1 million, and what kind of business we are going to be establishing. Do you have the skills to just be on your own? Do you think you are a one-man mofo? Permit me to use that word. Do you think you have all the skills that it requires to be the one running here and there, trying to make sure that the business is up and running, and also trying to make sure that every other thing is intact? Would you prefer partners? So all of these are the factors that we need to, if we are not business owners yet, I believe that majority of us would are looking forward to becoming an entrepreneur very soon, and that's if we are not one already. So these are some of the things that we need to consider while drawing up our plan. I want to have this big business. And so the factors that we need to consider are these. Would you prefer partners? Do you want to share profit with another person? Or you think, no, I don't think I need to do that. I should own all the profits to myself. Would you prefer partners? How much control do you want? Do you want to be in control of all the resources? Do you want to be in control of all the employees? Do you want to be in control of everything? Or you feel like, oh, I don't think I want to be everywhere and at every time. I should be able to outsource some form of control to another person. So these are the things that we need to consider when choosing the kind of ownership, the form of ownership for our business. Again, all these factors are very, 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 very important for us to make the right decision. You see that it still has to do with us, it still has to do with our choice, it still has to do with what exactly do you think you want for your business. And so that would determine the form of business ownership that you would venture into. All right, so we want to look at what exactly is business. What is the meaning of business? I know that once we hear the word business, what comes to mind is selling and buying. Selling and buying is one of the things that comes to mind. So what is a business? A business, okay, before I continue, is the font size too small or I need to zoom in? Please confirm that. Hello,
Actually,
Mercy, is it too small?
yes.
Oh,
I
okay.
didn't get that.
The font
Okay.
size, is it too small? Do I need to increase it?
It's actually small, yes.
Oh, okay. So let
But
me
I believe
see.
it's visible. I can still see it. Yes,
Okay.
it's fine. That's better now.
Much better.
Yes, please.
Okay. Thank you. So what exactly is business? Business is an organized effort by individuals or groups to produce and deliver goods and services that satisfy human needs. So, for every business that we see on the road, for every business that we see on the internet, their sole aim of setting up a business is because they have looked around, they have searched, they have discovered that, oh, there's a problem and I need to solve this problem. There's a need and I need to meet that need. And that's the sole aim of a business. A business is an organized effort by individuals or groups to produce and deliver goods and services. So they have looked inward. It's an organized effort, really. So it requires effort. For every business that you see running, you would understand, you would agree with me that effort has been put into that business for it to be alive, for it to be up and running. So it's an organized effort. And the major reason why they have come together to establish a business is because they have seen that, oh, there's a problem, there's a gap that I need to fill in this sector, there's a need that needs to be met, human needs. And they'll come up with a business idea. So that's why you see that people will look at the environment and say, okay, I think there's a problem with what's it called? Commutation. That's a transportation, moving from one place to another is quite difficult, probably because of the kind of environment they are in. And they see it as a problem. And what do? It's a need for humans in that environment. And what they do is they step in to do what? To meet or to satisfy the human needs. That's what a business is actually all about. Whether it's that small tailoring shop on our streets in Aba, or that tech startup, or probably the food processing companies, every one of them, every one of them did what? They followed the same fundamental principle, which is creating value for customers. So for every business that you see, every business, again, it doesn't have to do with the size. The main aim is to do what? Is to create value, is to meet the needs of people. So when they are meeting the needs of people in the environment, what happens is that they get value in return. They do what? They get refund, they get funds, they get income in return for the services that they deliver to people. So now understanding the different forms of business ownership is very, very crucial, as I had said before, because it affects everything that we do. Who owns the business? Who controls decision making? How funding is obtained? The potential. Okay, so how do we intend to grow the business on the long run? What are we looking out for? And so that's one of the reasons why that's some of the reasons why business forms of business ownership is very, very important that we study it. The right structure provides the foundation for stability and success. Okay. Okay. So I have here the business framework. For every business that we know, for every business that we have seen, there's a framework, there's a map which they follow, what is a blueprint, something that guides them. The first is inputs. And so when they have inputs can be in form of raw materials, it can be in form of capital, it can be in form of labor, that's employees, it can be in form of equipment, it could be in form of information. All of these are inputs. They come together and they say, okay, these are our raw materials that we have at hand now, and we are looking at how do we turn this into a business? How do we turn this into a finished goods that will now in turn generate profit for the organization? Now, so for the business framework, you have your inputs. These are the things that you have to process. These are the things that you have to critically analyze. How do I have all of these things in my disposal. I can get them. I can source for them. I can get capital. I can get labor. I can get equipment. Information is everywhere. How do I turn all of these things into a business? That's the input. After getting the input, you now look at processing. I have to process all of this for manufacturing companies. That's where you see that raw materials would have to go through process of what's it called? Process of being manufactured, process of turning raw materials into finished goods, the processes, the packaging, the branding, all of these things are processes. Now, for a service-based company, you are going to be looking at for their processes would be how do we deliver service? What kind of service are we rendering to the public? What kind of quality control do we have in check? So how do we ensure that the service that we are rendering to people meets the regulatory standard, meets the standard as it is prevalent in wherever we are working from? And now the next framework would be output, finished goods. After we have used our input, we have processed our input, what we have left is our output. The finished goods for a manufacturing company, then a good service, like a very, very good service. That's what we're going to call it for an output. So after you have done all your inputs, you have processed them, what you have next is the services and value delivered to our customers. The goals, everything I have said, the input, the processes, the output, there's a goal. There's a goal for trying to combine these three factors together. There's a goal for trying to um, put these three things, trying to put your input, trying to organize your processes, trying to ensure that your output meets required standard. And one some of the goals are profit generation. You want to get profit. You want to sell. And at the end of the day, every cost that you have incurred to be able to sell that product still does what? You still have enough money to run your business, which is your profit. You want to satisfy your customers. You cannot run a business and you're like, I don't care, whatever it is. There's a popular saying that customers are always right. Maybe not, or maybe, but at the end of the day, you want to ensure that your customers are well satisfied, because that is going to determine if you will still be in business. If they are not satisfied, the truth of the matter is you begin to see that your sales begin to dwindle, your profit begins to come down. Why? Because of what? Non-satisfaction of the customer. So these are goals that every business, like every business wants to do what? Achieve by doing what? By combining, by processing their input into output. They want to generate profit, they want to satisfy their customers, and they also want to enjoy sustainable goods. So when we talk about sustainable goods, we are looking at over the years, they want to grow, not like this year you are up, then next year you are down, you are just fluctuating. That's not the kind of growth that any business would want to get for its organization. You want to be able to sustain your growth. You want to have a sustainable growth. At the end of, by the time you are looking back and saying that, okay, for the last 5 years, this is what it has been for us. For the last 10 years, this is what it has been. So there's a trajectory that it's following, which shows that the business is actually sustainable. For every business, regardless of its ownership structure, regardless of how it's being run, who owns it, who doesn't own it, if you operate through this fundamental framework, even those roadside business, even our public limited liability companies, they follow through this. They get input, they process it to give what? To give value to customers. It begins with input, the essential resources like raw materials. I've said that. Then the result of these processes are the outputs. So again, some of the goals that every business would have is profit generation, customer satisfaction, and sustainable growth. So this continuous cycle of acquiring input, transforming them into outputs, and achieving goals form the operational foundation for any business, any successful business. So it drives their market presence. So that's all for the business framework. Now let's look at the business environment. The business environment, businesses do not operate in isolation, regardless of where they are operating from. No business can actually operate on its own. You can feel like even the sole proprietorship, even the one-man business doesn't operate on its own. Yes, so you can't operate in isolation. The truth is there's always going to be an interaction with the environment. There's going to be an interaction with other forces, external forces, or probably your internal forces. Excuse me. So they are deeply intertwined with their surrounding environment. Yes. And so the business environment also consists of both your internal and external factors. So the internal factors and the external factors, they play a very significant role in ensuring that a business thrives. It plays a very, very significant role. And some of the internal factors are, so these are elements within the control of the business. These are elements that the business has control over. So it has control over its organizational culture, it has control over available financial resources. How do I raise capital? Okay, the business will look at it and say, oh, I think we need to raise financial resources for this business. Do we go to the bank to get loan? Do we source for it from other people? Do I fund it with my own personal money? So all of these factors are still within the confines of the business owner. It's still within the control of the business. You can control it. You're looking at human capital, your employees, you have control over that. You'll be the one to select who is going to be your general manager. Who do you think will be very good at managing your finances, your finance person. So all these are the internal factors that can be controlled by the business. The technological capabilities, you know your strength. You know the business, of course, knows their strengths and also the existing infrastructure. What are the infrastructure that we have in place? What are the equipments that we have that we can use to successfully run the business? All these internal factors are factors that the business have control over. Again, the business environment is made up of two factors, the internal factors and the external factors. Now let's go to the external factors. Just like it sounds, external, you do not have so much control, is outside your immediate control, is outside the immediate control of the business. So you don't have so much control. And some of the factors that you don't have control over as a business, there's no business that have control over the inflation or interest rates. You cannot, especially if if the business has to do with foreign exchange. So by the time you give an invoice, now let me use myself as a typical example. I'm trying to explain external factors. So I work in a company where you are going to prepare an invoice using the prevalent exchange rates. That's how much you are able to convert naira to dollar. And at the end of the day, you wake up the following week after you had sent invoice and the dollar rate has tripled. So you can see that it's an external factor that I do not have control over. That those are economic conditions we don't have control over. Political stability and government policies, you don't have control over that too. Businesses don't have control over the kind of policies that governments make. So look at, in the case of Nigeria, by January 1st, 2026, we'll have a new tax law that is, of course, that's been passed into law and all that. By January 1st, 2026, its implementation starts, is effective at that date. So as at early this year, a lot of businesses didn't even see that coming. So these are government policies that we don't have control over. These are all the external factors. Your technological advancement. Some businesses years back did not envisage that a time would come where AI will be able to do virtually everything for us, virtually. Those are external factors that we don't have control over. The legal regulations. Sorry. The legal regulations, the environmental concerns. So understanding this and adapting to this factor is critical for survival and growth. I would always say that if you can, yes, you can control your internal factors, but since you cannot control your external factors, what do you do? It means that you have to be strategic. It means that you have to go back to the drawing board and now see how you can manage these external factors to be able to still do what? Achieve your business goals, achieve your business objective. So the internal factors and external factors are the business environment, and they are here to stay. They are not going anywhere. So all we need to do is to make good use of those factors. Core business functions. What exactly is expected of us as a business? What are those business functions? A business will be divided into different functions. You have to be able to effectively manage your inputs, your processes and outputs. Business relies on interconnected functions. Now, what does that mean? It means that for every function that we're going to be talking about, there's no one that is superior, more superior, permit me to use that word, more superior than the other. Why? Because they are all what interconnected and they are working towards achieving one goal. So even the management, the marketing department, the finance, the operations, the human resources, at the end of the day, when you look at all their KPIs, what they are supposed to achieve, what their goals, their targets for the month, their targets for the quarter, you would agree with me that everything still boils down to what? The business objective. So what are they doing? They are connected. They are interconnected. Now let's look at it one after the other. Some of the core business functions. The first one is what? Management. It involves planning. These are the people that are in charge of planning the whole business. They are the ones that will organize. They are the ones that will lead. They control the resources. They'll be the one to say, let's allocate these resources to here. I think we need to get another employee for this department. These are management decisions. These are management core functions. They organize the resources they have. They'll be the one to look at it and say, how do we judiciously put these resources together so that we are able to achieve our organizational objectives. These are the roles of the management. They ensure efficient operation and strategic decision direction. So the management will come up with the strategy of the business, the strategic direction. They are the ones that will come and say that the function lies with them. They will say, oh, this is where we see the business in the next 5 years. This is where we want the business to be in the next 10 years. And the management has the function of drawing out the roadmap, the blueprint. How do we intend to achieve it? How do we intend to get to this place that we say we want to be in the next 5 years? That's management function. And you see that everybody cannot be in the management. Everybody. So if everybody is part of the management department, or if everybody is part of the management, what happens is, who are they going to be leading? Who are they going to be allocating, or who are they going to be assigning roles to? And that's why I said that for every business function, they are all interconnected, and which means that every one of them will work hand in hand to ensure that the goals of the businesses are achieved. Then you have your marketing. They'll be the ones to say, oh, I think there's a need here that we need to meet. Promoting, selling, distributing, advertising, all these lies within the confines of the marketing function. Then for the finance function, you're looking at how they manage money, capital resources of the businesses. How do we go about our cash flow? That's the finance function. This is the function of the finance department, to be able to say that, oh, they'll be the one to report how much they've made, how much sales have come in, how much profits we have, what kind of investments can we put some of our reserves, our return on investment, what are we looking at, what kind of returns are we expecting from this kind of investment decision, including budgeting. Yes, so that's for finance function. Then the other one is operation, concerned with efficient production of goods or services. Supply chain, how do we get it across? Quality assurance and optimizing production processes. And we have the human resource. So this particular business function, they manage human capital of the organization. They ensure that they recruit the best talent for the business. They train. They ensure that employees are developed. They give us development, training, development. I'm trying to use the right word now. They ensure that employees get developed, so you don't become static when it comes to knowledge acquisition. That's one of the roles of the HR, the human resources. And so they look at the compensation and also maintaining positive employee relations. These are the core business functions that we have in a typical business. Now let's look at business models and strategies. Please remember that we are looking at the topic we are talking about today is forms of business ownership, but we need to lay the foundation of what business is all about before we go into forms of business ownership. A business model describes how a company creates, delivers, and captures value. It's the blueprint we have actually been talking about. It's the blueprint for how a business operates profitably. So this is the roadmap. What kind of business and what kind of model do we adopt to be able to operate profitably in a competitive environment? Yes. Strategy, on the other hand, is a long-term plan of action, like very long term. So when you're talking about strategy, you're not looking at a 1 year plan, you're not looking at 2 years, you're looking at from 5 years and above. Yes, designed to achieve specific business goals. Specific business goals. So these are strategy, a very long-term plan of action. So you have a long-term plan and you now do what you have to design specific business goals. What kind of the goals we are going to achieve within 1 year, the goals we need to achieve within the next 3 years. At the end of the day, what happened is we are still driving towards what our strategy, we are driving towards our long-term goal. Example of business models that we have now, we have B2B, that's what they call business to business. A company would look at it and say, the kind of business I am running now, is it business to business or business to consumer? Now let's look at business to business. Companies selling product or services to another businesses. So you're not dealing directly with the final consumers. You're not dealing directly with customers or consumers. So you are dealing directly with who? Business. So a business is selling to another business. Is that the kind of business that you want to run? So these are the models that we need to critically look into before venturing into a business. So are you going to be dealing with a fellow business as yours? Companies selling directly, selling products or services to other businesses. For example, Microsoft selling software to corporations like business owners. So you can see that Microsoft is a business to business model. Suppliers selling raw materials to manufacturers. Then we have B2C, that's business to consumer. The companies or the businesses selling directly to individual consumers. That's where you have Amazon, you have Jumia, you have your retail stores on your street, the supermarket. You go there to get some things. The kind of business models that is being used there is what we call business to consumer, B2C. Then the last business model we'll be looking at is subscription model. Customers pay a recurring fee for access to a product or service. Is that the kind of business you want to run? Is that the kind of business you want to manage? So do you want it to be that at the end of the month you just pay? That's what we have Netflix, we have Spotify for some of us that already have direct debits on some of these things. So you understand that the kind of business model that these businesses use is subscription model. Even the GoTV, the DSTV, yes. So those are the kind of business models. We have business to business, we have business to consumer, and then we have the subscription model. So before I continue, I want to be sure that you can hear me and you also understand all that I have been saying. Please kindly confirm that, and I'm not too fast, or
Yes, I
please
can hear you
confirm that
clearly.
you can hear me and you understand what I'm saying.
Yes, I can hear you. I can hear you and I
All
understand.
right, thank you very much. Thank you. All right, so I believe that we had one way or the other touched this particular one, why businesses exist. So we'll just go over it again. Some of the reasons why a business exists. The first one is to generate profits. Most importantly, as long as the business is not a non-for-profit making organization, as long as the business is not a charity organization. I know that some of us, just like Transformation College now, Transformation College is an NGO, right? Yes, it's an NGO, and so they might not be part of the kind of businesses that will say that they are running specifically because they want to generate profit. So now, not this kind of companies, for every other kind of businesses that we see, they are doing what? They are existing because they want to generate profit. They want to make financial returns. It's getting to the end of the year and you start seeing financial reporting. Oh, we need to have meetings. How much sales have we made? How much profit do we have? Yes. So these are more, these and more are some of the reasons why businesses exist. They want to generate profit. They want to satisfy needs. They want to satisfy needs. Transformation College is actually satisfying the needs of knowledge acquisition. Yes, satisfying the need. Businesses identify and fulfill customer needs through quality products and services that improve daily life, then support economic growth. Whether you like it or not, as a business, you are supporting economic growth. And I think, not like I think, that's one of the reasons why the new tax law that is going to be effective from next year, 1st of January. So they want to also do what they want businesses to be able to contribute massively to the GDP. And that's why they are encouraging small business owners. Prior to this time, you will have that if you are whether you are a small company, before then, what they usually call a small company in Nigeria is a company that earns below 25 million. But now, from next year, that's January 1st, 100 million is actually the threshold. So you are going to, what are they trying to do? They're trying to do what? Encourage businesses to do what? To come alive. They're encouraging that, please, we need more business to come. What happened is that you are contributing to the gross domestic product of the country. You're also strengthening national economic development and global competitiveness. So yes, businesses exist because they want to support economic growth. The next one is they want to create employment. As long as you are not the manager, you are not the financial manager, you are not the HR person, you are not the operations manager, one person cannot run all of these things. What happens is businesses will now do what? Create employment for people. So because your boss cannot be the one to do everything, what happens is when they establish the business, they look at it and say, we need to create the employment opportunities for people. We need to provide jobs to be able to support families. So yes, businesses exist because they want to create employment. They also want to drive innovation. Very important. Innovation. It wants to develop new technologies, improve processes. We have done it before. We have done it again and again like this. Can we get better? So that's one of the reasons why business exists. They will look at it and say that this process we have used over time, this is the result that we have achieved. Can we try a better solution? Can we try a better approach to these things? Can we develop new technologies? Can we adopt new technologies? So yes, it drives innovation. You begin to think beyond, outside the box. You begin to look at it and say, I'm not the only one in this business. People are competing for market share. So I also have to do what? Up my game as a business owner. So that's one of the reasons why businesses exist. It also builds community. Modern businesses embrace corporate responsibility, ethical behavior, and social impact beyond profit making. And that's where we have our CSR, that's your corporate social responsibility. These and many more are some of the reasons why businesses exist. All right. So now we have looked at business as a whole, the fundamentals of business, what exactly is business. And so we gotten to the point where we want to really look at the forms of business ownership, the main reason why we are here. And so for the forms of business ownership, we have primarily we have three forms of business ownership. It doesn't mean that these are the only forms of business ownership that we have in the economy. What it means is that these are the three primary forms of business ownership. So if you're not a sole proprietorship, it's either you are in partnership or you are a corporation. We have special forms of business ownership, and we'll be talking about that much later. Now let's look at this. We said here that these three forms represent the foundation of business ownership worldwide, including Nigeria. So everywhere you go, be it UK, be it Spain, wherever you find yourself. So these three forms represent the foundation of business ownership. They differ significantly in ownership structure. There's actually differences between the three of them, of which we are going to be looking at. Understanding the differences is very essential to choosing the kind of structure that best fits your business goals. So the goal that a partnership aims to achieve is different from the goal of a sole proprietorship. It's also different from a corporation. So now you need to understand what kind of business goals do I want? What are my business goals? And that would also guide us in doing what? In choosing the form of business ownership. Yes, and so I said here that Nigeria also recognizes specialized structures such as cooperatives, joint ventures, all of those things will be explored later. Let's look at sole proprietorship. Sole proprietorship. So sole proprietorship is one form of business ownership that we all know. Some of us call it one-man business. That's another word for it, especially in Nigeria, and I believe that's the same for other parts of the world. So when you want to describe a sole proprietorship, you just say it's a one-man business. It's only one man that owns. It's one man that provides the revenue. It's also one man that takes all the profits. That's what a sole proprietorship is. A sole proprietorship is a business owned and managed by one individual. That's the meaning of sole, just one. It's the simplest and most common form, very simple to run. And that's why everybody is now a CEO. When you ask them, I'm a CEO, everybody, most especially on the streets of, don't let us go there. So everybody is a CEO because of what? Because sole proprietorship is the simplest and most common form of business ownership. So I can own a business. Every one of us on the call can own a business. That's what the sole proprietorship does for us, especially among artisans, small traders, freelance service providers, and micro businesses. So sole proprietorship is a business owned and managed by one individual. Examples of sole proprietorship, you'll be looking at your fashion designers. They are the ones that own it. They are the ones that are managing it. The small retail stores on your street. You can't go to the supermarket. You just walk down outside of your house and you want to get something. These are sole proprietorship. Freelance consultants, writers, catering and food vendors, many more. Like we know that they are very common because it's easy. It's very easy. Every one of us can just wake up and say that I need to have my own business. I need to have my own business. That's where sole proprietorship comes in. Now let's look at some of the advantages and we also look at some of the disadvantages. Please understand that the sole aim of today's session is to ensure that we have a very good understanding of the kind of business that is available or the kind of business ownership that we want to achieve, that we want to get. What kind of business do you want to own? So that's the sole aim of today's session. The advantages of sole proprietorship, very, very easy. You have complete control. A typical fashion designer has complete control over decision. He or she is the one that makes decision, but there's nothing like we are going to be having a board meeting. I don't think that works in a sole proprietorship. So he just wakes up one morning and feels like, okay, I think this is not working. He just implements that policy. Very easy. So you don't need to start running through and saying, let's go and have a meeting. We need to strategize. Of course, they don't just make uninformed decision. Do you understand? But what happens is that they have complete control. And so it reduces the time of trying to, sometimes being strategic can take time. You start, let's develop this strategy today. You take time, you try to do all the whole strategy, get all the required. And at the end of the day, you see that time is going. But what happens here is one man has complete control. You just really want to make the decision. It's very easy and inexpensive to fund. It's very easy to fund. Very easy. That's why every one of us can become a sole proprietorship. Easy, and it's not so expensive. You go some business owners will tell you that they didn't even start with money. They just started with maybe drop shipping. That's another form of sole proprietorship. So not so expensive to establish. Direct retention, I think that's one of the driving force of sole proprietorship, because they'll look at it and say, I'm the only one retaining all the profits. And so that's one of the things that one of the advantages of a sole proprietorship. So direct retention of all profits. All the profit goes back to the owner of the business. So there's nothing like um, for a corporation now, you now start saying we need to pay dividends out of our profits. We need to, this is what we call retained earnings. All of those things, we don't have them here. So it's just him alone, just enjoy it by himself. Then you also have minimal legal requirements. So the requirements that is expected of him is very, very um, small, not so much that robust, and you have to file for this, file for that, compared to a limited liability company. Very flexible, very, very flexible. So it's not rigid. A sole proprietorship is not rigid. You can wake up this morning and you just discover that this policy I implemented last year, I think I need to adjust it. Before you know it, they've adjusted it. That's one of the advantages of it. It's flexible in operations compared to other forms of businesses where you cannot just wake up and make decisions. You cannot just say we want to adjust or we want to change what we had put in place prior to this time. Then now let's look at some of the disadvantages of a sole proprietorship. Some of the disadvantages: unlimited personal liability for debt, unlimited personal liability. So this is one of the major, I would say that this is actually the major disadvantage of a sole proprietorship. What happens is that if the business runs into debt, the business is not able to, it's not liquid enough to be able to fund to be able to service his credits, right? What happens is even his own personal income can go into it. So it's unlimited. Your liability is not limited to what the business owns alone. Even your personal income, your personal money, you can, as a sole proprietorship, if you are owing somebody, the person can wake up one morning and say, I will just come and pick up your generator, the one you're even using in your house. Or you will even be the one to say, I think I need to even sell my car so that I can pay this debt. So yes, that's one of the disadvantages of a sole proprietorship. Limited access to capital. They cannot raise capital from the public. What happens? They have limited access, apart from maybe their personal savings, apart from my uncles, for some of us that have rich uncles, or some of us that are even rich uncles on the call. And so you'll be the one to fund, be the one to do what assist the business or a sole proprietor. So we have limited access to capital. Heavy workload on one person. This cannot be overemphasized. This is one of the disadvantages of a sole proprietorship. The workload is on one person. You are the one with the strategy. You are the one thinking of how your business will be in the next 5 years. You are the one thinking of who do I think I need to employ now. You are the one thinking of how much how much money do I need? Where am I supposed to get cheap affordable resources? All of these things is what on one person. Of course, because it's being owned and managed by one person. So the business continuity challenge for a business as an accountant, one of the things that we know and is very, very key for every one of us to understand is that the going concern concept is ensures that for every business, what happens is we assume that this business will live forever. Like we are not foreseeing that this business is going to liquidate in the next 5 years. So that's how we deal with businesses. But that's not the same. That's not even applicable for a sole proprietorship. You cannot assume that a sole proprietorship is going to continue for years. Now let's even look at it critically. That's why some of practically just within us, you'll see that some business owners, once they die, especially if their children do not even have knowledge about the kind of business that they run, that automatically means the end of the business. That's a disadvantage, a very big one at that. Business continuity challenge. So because it has been only them, they've been the decision maker, the decision implementer. So what it means is that at the end of the day, the business might not even continue when they are sick. You just see that this person is not even opening the company, or this person is not opening the shop. Why? Because it's a challenge, it's a disadvantage. They are not able to continue the business. They are not able to continue. So the alpha and omega of the business, once the alpha and omega of the business is down, of course, the business automatically is also down. So limited growth potential. You cannot expect that a sole proprietorship will begin to compete market share with a limited liability company. I'm not saying that it is totally impossible, but what I'm saying is, of course, some of the factors are limited already. They're actually very limited growth potential. So there's a particular threshold that you see that, oh, this business can't even go beyond compared to when it is a limited liability company. And so these are the advantages and disadvantages of sole proprietorship. So again, for everything that has advantage, has disadvantage. You can look at it and say, the disadvantage, when we get there, we'll cross over. Let's just start. Very good. So the most important thing is that you understand that whatever has advantage also has disadvantage. So you as a business owner or potential business owner will now be the one to say, let me choose my kind of disadvantage that I want. Let me choose the kind of advantages that I also want. So let's move to the next one, which is partnership. Partnership is an association of two or more people who jointly own and operate a business. Is an association. Two or more people will come together and say that, I don't think I can run business alone. I don't think I have the. Remember that when I started, we said that you were giving $1 million, and you now need to sit down and look at the kind of business that you will run. And some of the factors I spoke about was, do you have the skills that it requires to run a business alone? And that's what gave birth to partnership. So many people have done sole proprietorship for years. They have done it and they just looked at it and said, I'm not even sure this thing. We can actually be better. It can be better. Like the popular saying, a two good head is better than one. Yes, two heads are better than one, but we would always say two good heads are better than one. And that's what gave birth to partnership. A partnership is an association of two or more people who jointly own and operate a business. It could even be, a partnership could even be an association of sole proprietorship. Sole proprietors, yes, sole proprietorship. This person is a business owner, is a sole proprietor. We have another sole proprietor, and the person looks at it and say, I have been running this business for the past how many years now? Can we come together? Let's look at the kind of business that we can run together. So that's what a partnership is. Partners, they share profits, they share responsibilities. So you see that this is an advanced level of sole proprietorship. Responsibilities, the risk is also shared according to their partnership agreement. So for every partnership, they have what guides them, and that's what we call the deeds of partnership. You look at, in the deeds of partnership, it contains the profit sharing formula, what happens what happens when a partner dies, what are the things that are guiding this partnership, how much capital is expected of this partner, what are the rules and responsibilities that this partner is also going to be contributing. Is it going to be a dormant partner, or is it going to be a partner that will just contribute his name to the business? Is it going to be a partner that will be the one in charge of the day-to-day operations of the business? That is what is embedded in the deeds of partnership. So now some of the primary types of partnership that we have. General partnership, all partners, they share management responsibilities and they have unlimited liability. So that's one of the similarities between partnership and sole proprietorship. There is unlimited liability. So if anything happens to even the partnership, what happens again is that they have to sell their personal properties. They have to start contributing. We need to pay this person, bring money. We need to pay this. Can you bring your car? Let's offset. We need to do this. So they have unlimited liability for business debt. Each partner can make binding decisions on behalf of the business. Then the limited partnership, just like I said, they are not like the general partners. They are limited partners, so they invest capital, but they don't have management role. So it is just the capital that they have invested that is liable to get lost in the form of maybe business in the face of business liquidation. So it includes both general partners with unlimited liability. So a limited partner does not have to sell his or her personal property to offset the debt of the business. So these are the difference. General, they are involved in everything, the day-to-day running of the business. Then the limited partnership, but they have no management role and limited liability exposure. So now one of the considerations for this partnership is that partners are jointly liable for business debt, meaning one partner's decision can affect all partners. Yes, very important. And that's the emphasis on who are you partnering with. That's one of the things that we also need to consider before you go into a partnership. Remember that we are discussing forms of business ownership. You are going to look at it critically. Before you go into partnership with anybody, you ask yourself very, very simple questions. This person, does he have the ability to make right decisions? Does he have the ability to make decisions that will not affect the business growth? Yes. So a clear partnership agreement is essential, very, very essential, and that's the also aim of the partnership deed. And now we'll go to cooperation as a form of business ownership. Forms of business ownership, corporation. So what is a corporation? A corporation is a legal entity separate from its owners. So it's actually separate. So we treat the business as a separate entity. The business is treated as a separate entity while the owners are treated as a separate entity. That's what a corporation is, known as shareholders. This separation provides significant advantages. Shareholders enjoy limited liability. Oh, their personal assets are protected. Remember, so at the end of today's class, it means that you already have a clear picture of the kind of business that you want to run. Maybe in the next 5 years, maybe in the next 10 years. So your personal assets are protected. The business can raise large amounts of capital by selling shares, and the corporation continues to exist regardless of changes in ownership. Regardless of that, this is where we call companies. However, corporations faces more complex registration. Yes, so the process of running a corporation is not as seamless as a limited liability, as a sole proprietorship or partnership. So you can see that they all have advantages and they also all have their disadvantages. So this is a makeup of a corporation. A corporation have a board of directors. They set strategic direction. They appoint executives. They have corporate records. Yes, they are in compliance. They follow through the statutory compliance, statutory requirements wherever they are operating from. So they also have management team, the people that do the day-to-day running of the business. So we have looked at sole proprietorship, we have looked at partnership, and now we are talking about corporation. Now let's look at types of corporation. Remember that I said earlier that corporation is a business that is treated separately from the owner, and that's why we gave birth to the limited liability. When we spoke about sole proprietorship, we kept on emphasizing on the fact that they have unlimited liability. But for types of corporation, we do have limited liability. But there are different types of corporation. They are actually different kinds. But the similarity between all of this is that the business is separate from its owners. Yes, so let's quickly look at types of corporation we have. Public limited company, public limited company. A public limited company, just like it sounds, is a company whose shares are traded on a stock exchange and can be bought by the general public. That's a public limited company. Their liabilities are limited and their shares can also be traded on the stock exchange market. Yes, they can raise significant capital, yes, by offering shares to a broad investor base. For a public limited company, when they need money, they don't need to start looking at which uncle, because it's separate, it's very, very distinct from a sole proprietorship. And again, their personal money might not even be enough to even run the business. And that's why they have the right to do what? To call for people to come and buy their shares. That's what the public limited company do. That's one of the ways they raise capital. So you see that they can raise significant capital. And that's why you see that when the GTB or Zenith Bank, all these public limited liability companies, when they need to increase their funds, what they do is they just issue more shares and say, oh, okay, please, for the very first time, this is how much we are going to be paying for. We are going to be selling our shares. And they can also do rights issue for existing shareholders already. Okay, you're already an existing shareholder. For if you have two, you can get one more. If you buy two, you can get one. You can pay for one. So that's how a public limited company works. And some of the characteristics are public traded shares, just like I said. The ownership is broad. For a public limited company, you can't even say there is one person that owns it. What happens is that if I buy shares in GTB, if I buy shares in Access Bank, I am part of the shareholders. Yes. And so you can see that even the ownership is quite broad. The regulation for a public limited corporation, public limited company, is that it is usually subjected to strict regulatory oversight, like very, very strict. So they don't just do as they wish. They would always publish their financial statements. They will do everything as is required by the statutory bodies set in Nigeria. They must disclose requirements, of course, because public people, public investors are involved. And so what happens is that the government wants to ensure that the public investors, their stakes are protected. Their stakes are not, that's the interest. Whatever you have invested in a public limited company, the government will ensure that they are up and doing, wants to ensure that they are following the stipulated standard. So example, we have talked about Access Bank, GTB, Dangote Cement. So for all the public limited companies, just know that their names usually end with PLC. So whenever you see any company that ends with PLC, just know that that's a public limited company. That's a type of corporation. Then we'll move quickly to private limited company. Private limited company. A private limited company ends with LTD. I think this is one of the type of corporation that is more popular, that we have everywhere. A private limited company. A limited company has shares that are not offered to the general public. Yes, they have shares, but you cannot sell to the general public. Ownership is typically restricted to a small number of shareholders. So you can just have maybe two or three, exactly, often family members. So for a yes, a private limited company, when you're talking about the ownership, you'll be looking at probably, if it's a man that owns the business, the man is one of the shareholders, then the wife, then the children. That's private limited company setup. Usually they are family members or private investors. What are the characteristics of private limited company? Their shares are not publicly traded. They cannot come out tomorrow and say, we need funds. Please, can you come and buy our shares? No, that's not possible with a private limited company. Yes. And so they are often smaller in scale. They are smaller compared to PLCs, that's public limited company. The regulation, there's actually regulation, but not as strict as that of a public limited company. And so examples of private limited companies, some of them will be, as long as their name ends with limited, just know you have Business Solutions Limited, you have A4S Limited, you have Training Life Limited. All these are private limited companies. Yes. And so they are registered as private limited companies. And now we have not non-profit corporations. These corporations are organized for purposes other than generating profit for owners. So it's not just they have been established not because they want to generate profit for themselves, not because they want to generate profit for the owners. Their primary aim is to serve charitable, educational, religious, and social causes. Remember when I spoke about Transformation College, I said that this is a non-profit corporation, because the sole aim is not just to make profit, it's not even to make profit. So they want to meet charitable cause, they want to meet educational cause for Transformation College. Now, for religious, so what are their characteristics? They are mission driven, surplus over their revenue. That's when they begin to prepare their accounts at the end of the year. So when they don't call theirs profits, they don't call it loss. It's always surplus and deficit. So these are characteristics now. For public limited company and private limited company, we will say that they want to earn profits, they want to make profit. But for a non-profit corporation, at the end of the day, let's assume that for every donations that they received, that's a non-profit corporation now, they were able to receive donations from people brought in money, and whatever it is they incurred, all their costs was not up to the amount that was donated or that was contributed. What they will call it is surplus. So surplus is reinvested. It's not shared. It's not distributed to owners. Just like I said, for a limited company, you begin to think about dividend. We need to pay our preference shareholders. We need to pay our dividend, our ordinary shareholders. We need to pay them dividends. No, probably for a limited company now, we need to pay bonuses to our directors. That's not the case for a non-profit corporation. So it is mission driven. They have sole aim, and it has to do with humans just meeting their basic social needs, welfare, to be able to meet people's needs, and not even to make profit. So usually they are tax exempt, they don't have to pay tax. Most cases, very, very most cases, but they must adhere to the rules guiding the operations of non-profit corporation in the country. Now, let's look at some of the examples of non-profit corporation. Many NGOs, so many NGOs. We have so many NGOs in Nigeria, like Youth Empowerment Initiative Nigeria. All these foundations that were established just to ensure that the social welfare of people are considered and are met. So these are the types of corporation. We have public limited company, we have private limited company, and we have non-profit corporations. All of them are registered. Yes, they are always usually, they must be registered with the CAC, Corporate Affairs Commission. They are all registered. The non-profit, the private, the limited, they must all be registered. But their mode of operation is what differentiates them. Now let's look at the key differences. Of course, because we have been able to look at the similarities, and we know that there are so many differences between a public and private corporation. Public and private corporation. So the public limited company, we said that the ownership structure, it is owned by shareholders. Shares are owned by the general public ownership, yes. So for public limited company, shareholders are the owners of the business, while for private limited company, because they can't sell their shares to the public, what happens is it's concentrated on them and stable. Ownership is concentrated and stable. So just the number of individuals that are that are called their shareholders, more like the owners of the business. I remember I said when I was talking about the structure, I said that for private limited companies, what they do, since they can't sell their shares to public, since they can't call for IPO, that's the initial public offer, call on public to come and buy their shares. What they do is you just have them, they say, okay, the owner, probably the wife and the children are the shareholders of the company. So that's the difference between ownership structure between the public limited company and the private limited company. So I think we have talked about regulatory requirements. And so capital raising abilities too, yes, I already said it, I already spoke about initial public offerings. Okay, now let's look at the disclosure requirements. I think this is very important. A key difference between the public limited company and private limited company. For the disclosure requirement, it is very, very mandatory. There's no way that you can't escape it. It is very, very mandatory. An extensive public disclosure of financial performance and business operations to ensure transparency for investors. That's why you can go online and search for Dangote's financial statements. Is there. You can go online and say, oh, I want to even see how this business is run, especially if you're a shareholder or you are thinking of, I think I want to buy shares in this company. You can just go online. So because it's a requirement, they have to disclose everything. It's not just for them now. The public also have to be carried along. The public has to know. That's for every investor. They need to be able to see the business operations, especially when it has to do with their finances. So it is very, very important, very mandatory. There's no two ways about it. So at the end of their financial year, so you see that they will publish their financial statement. But it's not the same for a private limited company. No. So it's usually kept private amongst themselves. So for a private limited company, it will just be among the business owners, the management staff, or probably key stakeholders in the organization. So those are the people that will really know what it is that that is embedded in the disclosure requirements. So again, the private limited company they don't have that public reporting. They are not mandated to start publishing their statements. They are not mandated. No, that's a very key difference between public limited company and a private limited company. Okay, so I want to be sure that, okay, so let's quickly run through this. We'll be clean on break. Okay. So just like we had spoken about partnership, we're looking at this is not a popular or probably a form of business ownership that is stipulated by law, right? So family business partnership, and this has to be interactive now. We have looked at sole proprietorship, we have looked at part, but you would agree that some businesses would usually have businesses around that would involve family members, their spouse, their family members, you understand? So a business that is deeply rooted, it's just the family members that are running the business. They are everywhere, and that's why we want to look at them, some of the advantages and the disadvantages. Do you think that you want to own a business with your husband? Do you think you want to own a business with your cousin? Do you think you want to own a business with your family member? Yes. So now let's just look at some of the advantages of business partnership with spouses and disadvantages. Let's look at some of the advantages. So some of the advantages is that you have deep understanding. Yes. So spouses often possess intimate knowledge of each other's strengths, weaknesses, and work style, okay, which can lead to highly complementary roles and efficient operations. Okay. So yeah, so when you have deep understanding, there's a particular man, I don't know if I can remember his name. He's on LinkedIn. I think I met him on LinkedIn. He was talking about how his wife is working in the business, like they are co-owners, but the wife has her own department where she's heading. And when they come to the business, everybody's just work oriented. Nobody's looking at whether that's my wife, that's my husband. And so when I saw this particular one, that family business partnership, my mind went straight to him. I'm like, oh, really? So it's actually very possible that, very possible. But the fact that it's possible does not mean that it doesn't poses some of challenges too. So flexible work-life integration, so they can share their personal lives because they know themselves very well. They can also do what? Use their relationship, use their experiences to facilitate a better family time management. Yeah. So if husband and wife can run a business, they can look at it and say that, okay, maybe I'll be at the office on Mondays while you'll be at work on Tuesdays, so that the family too does not do or does not suffer because of the business. These are some of the advantages. Shared vision and values. So they have common values. They have long-term goals. So they'll come together and they'll say, oh, the fact that we are spouse even makes it easier. Every one of them is working towards the same goal, compared to where you have to coerce or motivate an employee. So you see that if you're working with your spouse, this is not to encourage it, right? I'm just trying to make us understand some of the advantages. So when you're working with your spouse, you don't have to go through that rigorous process of trying to share your vision with the person, trying to make the person understand why the business has to be up and doing. Yes, so they have shared vision and values. But some of the disadvantages: limited financial options. Yes, so the husband has a 1 million naira, the wife has a 1 million naira. You bring it together, so you are not able to you are not able to source for external finances. So it's just the spouses alone. So these are limited financial options. Potential for over involvement. Yes, over involvement. It becomes very risky. Emphasis on very risky. When you begin to bring family problems to the workplace. So the close personal relationship can blur boundaries. Yes, it can actually blur boundaries. So you now begin to feel like, is this not the person I will go home and meet? Why do I have to now start doing work when I see the person at home and all of those things? So these are disadvantages. Too much togetherness, especially when you see yourself at home. You still come to work again, you continue from where you stopped at home. That's it. So work-life balance challenge. Maintaining a healthy separation between professional responsibilities and personal life is difficult. Yes, it can actually be difficult because all of you are in it together. You begin to see the business as is already part of you. So you begin to treat it more like your home. The same way you treat your home, that's the same way you treat your business. And you're not able to strike a balance between, oh, this is work and this is family. So that's one of the disadvantages of partnership with spouses. And so before I continue, we would have to um, contribute, like, what other um, disadvantage do you think that this kind of partnership will bring? Do you think is even important? Do you think is something that you would like to do to run a business with your spouse, and maybe not your spouse now, even a family member? So please, open. Can we hear from some of our participants today? I hope you can all hear me. Maybe you don't want, you can just
Yes, we
chat,
can
you can
hear
send a
you.
message. Okay.
Yes, yeah, um,
Okay.
yes, um, about our friend, you to normally communicate and complicate the business, like to bring in personal problems and other stuff. So for me, it's a no.
Okay. So like you're very outright with that. You know, no, we are not thinking about, we're not deliberating. Let my spouse go and work somewhere else. Let me also go and work somewhere else. Okay, so thank you for that contribution. Thank you very much. So that's family business partnership, the disadvantage and the advantages. So we will just run through some of the things left are some of the things that we have spoken about before now. So now let's look at, we're talking about business. We're looking at how do we organize the business for success? We have looked at what business is. We said business is a combined effort so that people come together. They want to do what they want to satisfy human needs. What are those things that they need to do? And critically analyzing the kind of business ownership that they want to be in place. Now they will now look at it and say, we need to be successful. Every business wants to be successful. No business sets out to fail. That's very important. Like there's no business that is being established with the sole aim of failure. Absolutely no. But some of the things that we need to put in place to ensure that success for the business is achieved. So the first one would be every business needs clear structure that establishes roles, reporting, relationships, and authority level. Yes, very important to ensure smooth communication. So all of these things are things that we need to do or put in place to ensure that our business is what successful. The first one is what hierarchy. You need to define the level of authority. So if you are not going to be using sole proprietorship, where we know that the alpha and the omega of the business is the owner, is the sole proprietorship. So even for hierarchy, you can adopt it for partnership. Yes. So for partnership, they will look at it and say that, okay, so this is the people that make sole decision. They have other workers, they have employees in partnership too. The fact that it's a partnership does not mean that there's no room for them to be able to employ others. Even a sole proprietorship can employ people. And so that's where hierarchy comes to play. It defines the level of authority from top management to frontline workers. So it's very clear. So when you walk into an organization, even from the reception, you already know the people that are frontline workers. You already know the people that are middle management staff. You already know the people that are top management staff. That's hierarchy. And it is very, very key for the success of a business. It's very, very key. So if everybody is operating at the same level, you agree with me that there'll be confusion everywhere. Nobody knows who is the head. Nobody knows who I'm supposed to report to. There's no level of authority. We just see ourselves as we are just on the same level. It's not going to make a business successful. Hierarchy is a very key concept. Then the next one will be chain of command. Who am I reporting to? You know, when you're talking about chain of command in an organization, you're working in an organization, and it's not clearly stipulated who you are supposed to report to. And now one person comes and say that I need report on this. Another manager comes and say I need report on this. You see that there's going to be disarray in the workplace. And so that's why we need the chain of command. You clarify who am I supposed to report to? What's the flow of instruction? What's the flow of communication? It doesn't mean that I'm not going to interact with every other person. It doesn't mean I'm not going to interact with other management or other workers, but there needs to be a chain of command. This is who I am reporting to. This is the person I get orders or instruction from. Very important. Then the span of control. How many subordinates report directly to each manager? So for effective leadership, to ensure that the leader or the manager is not overly stressed, you need to understand how many subordinates report. So if you have a manager that has like 20, 25, or say 50, let's say 25, I don't want to exaggerate, 25 subordinates that have to report directly to the manager. So this is not, when we're talking about of control, I'm not saying that so as a top management, you have to have maybe one or two people. You don't need to know what is happening. No, that's not what it means. What it means is that who is reporting to you, it makes the work easy. So if I have 10 people in a department, you have your manager and you report to your manager. What happens is that manager now probably you get a group of say 4 or 3 or 5 or 10 managers. that will now do what? Report or supervisor. Let's even use the word supervisor. That will now do what? Report to a middle or top level management. So it makes it easy. It makes it easy than when you have to account for how many so many subordinates that are reporting directly to you. It would also do what? Affect quality and communication efficiency. Another concept would be division of labor. Division of labor. I remember when I was taught division of labor in secondary school, it didn't make sense until I started working in a corporate organization. That's when I began to understand. Okay, I think this is what they were teaching us in business studies that year, right? So division of labor is a very, 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 very important. You saw when I was talking about sole proprietorship, where the owner of the business is the one that is doing everything. So there's no division of labor. What happens is when there's division of labor, people are assigned to tasks are assigned to different individuals. You know their strengths, you know where they can function, and you say, okay, this is it. You really want to, you are responsible for this particular one. You are responsible for the operations. You are responsible for the finances reporting. Even in the finance department, there's also division of labor. Oh, you are responsible for the receivables and payables. You are responsible for investing decisions. You are responsible. What happens is that it makes the work, it makes even the labor, that's the employees, efficient and effective. Yes. So it also fosters proficiency and higher quality output. You see that higher quality output is very important because an employee can be everywhere, can be doing so many things at the same time. And at the end of the day, the output is not, you can't even quantify it. You can't even say that this is no. There's no quality. Like you just look at what he or she has done. Person is telling you, I've been working since morning, I've been doing this, I went to this place, I went to that place, I did this, I did that. And at the end of the day, there's no quality output. So you see that division of labor is very, very important. Now, for example, in a manufacturing company, tax are segmented into raw material procurement, assembly, quality control, packaging team. So even for the raw material in a manufacturing company now, you have people that are in charge of going to source for raw materials. You have people that are in charge of assembling, processing the raw materials. You have people that are in charge of, we need to analyze, we need to check what has been done so far. Does it meet our required standards? That's quality control. You have people that are in charge of packaging the items. We need to package our brand. We need it to be catchy and all of those. That's division of labor. It enhances efficiency and increased expertise. So if division of labor is very, very prominent or very, very key in an organization, you would not have the reason to say jack of all trade, master of none. So whenever I hear that word jack of all trade, master of none, it simply means that you have been doing everything to the extent that you've not been able to do what? Acquire expertise in a particular place. That's just where we got that jack of all trade, master of none, really. So that should not be the case in an organization that has division of labor. So if they need somebody they need an expert in a particular field, they need an expert. It doesn't mean that you don't have little or few knowledge about other departments or what they do, but let people know what you can do, your strength. Let them be able to say that, oh, we need someone who can quickly go and get, for the case of urgency, we just got an order. We need someone who can quickly get us materials, like source for quality materials at once at a minimized cost. Who is that person? Will they just pick a random person because you are always everywhere? Because you can go out and buy something and no, that's not what increased expertise is. So communication channels too, always very important that a company has communication challenge. So let me talk about this a little bit. For this communication challenge in an organization, I read somewhere, I think was it yesterday or 2 days ago, about this brigadier that was killed in Nigeria, and people were saying that he escaped and he was trying to communicate via WhatsApp to his superior that, oh, this is where I am. And so because of that channel, I don't know how porous it was, the people that were going to attack him eventually found out where he is. So as an organization, we need to have a clear communication channels like that flows within organization that cannot be easily accessible to even outsiders. Very important when we're talking about communication channel. So you have formal channels, you have informal channels. So when you have your informal channel, that's where you can have your maybe your WhatsApp chat, all of those things can be informal channels. And when you're talking about formal channel, it could be your company's intranet, your company's network. Yes, let me use that word, intranet, that has been established just for the internal purpose alone, formal channel. So you know that directly every mail is sent to your manager. So it's a formal channel. What happens is it makes it easier. So when you're not talking about maybe social interactions, that's where you go through the informal channels. So managing both formal and informal channel is vital, very, very important in minimizing understanding. So you don't use an informal channel for a very official communication, or you don't use somebody via mail. You're asking the person very cordial questions that you could have gone to the person's WhatsApp to just ask the person. And so that's why some organizations will use Slack, yes. And so you know that on the Slack, there are some communications, there are some things that you cannot say there. It has to be strictly work, like strictly work oriented. So yes, managing both formal and informal channels is vital for minimizing misunderstanding, also facilitating decision making and aligning effort towards shared objectives. Talk about, okay, organizational models. You have your functional structure. So this business is organized into specialized departments like production, marketing. We have talked about that before. So each department focuses on its specific function. So now, at the end of the day, what kind of organization models do you want to adopt for your business? Your functional structure has to be clear. Like this works well for small to medium business, yes, with clear functional needs. So you know that for the human resource department, I need someone who is going to help us recruit the best talent there. And so you just set it up. I need someone who will be able to help us manage our finances properly. And so that's functional structure. Then for divisional structure, business is divided based on product. So that's where we have yes, product. So for accounting, you will call that departmental accounting. So for divisional structure, business is divided based on products, based on services, based on region or customer segment. So you know that this particular department or this particular structure, this is the kind of product that they produce. This is the kind of product they produce. Then under it, you can now begin to say, for this structure, or for this segment of the business, we have other people that are working towards the shared goal. So it could be region. I have businesses in Lagos, business in Nigeria. So it could be divisional structure, it could be functional structure. Each division operates semi-independently. Yes, very important. So for functional structure, they are all interconnected. But for divisional, there's a level of independence. Yes, a level of independence among the division, yes. So large corporation with diverse products, yes, makes use of this particular one. Just like Dangote now, yes. Dangote is a typical example of a divisional structure. You will see that he has varieties of products. He produces cement, he produces food items. So there's a level of independence for the cement company. There's a level of independence for the company that is producing food items, the sugar, and the likes. So that's divisional structure. Then matrix structure, it combines functional and divisional elements, creating dual reporting relationships. This can be very, very complex. This particular one is usually complex. Employees report to both functional and divisional manager. That's matrix structure. It can be very complex. but it improves flexibility and cross-functional collaboration, especially if you don't want it to look like it's just your department alone, just people within your functional areas that you are collaborating with. So matrix structure will help you improve cross-functional collaboration. But again, it can create complexity. It can be very complex. You can imagine that I have to report to, I am working in a matrix structure. So I have to report to my functional manager. As a finance person, I have to report to my finance manager. And now I also have to report to, let's say I'm also working in Lagos region. As much as I'm going to be reporting to my finance manager, it simply means I also have to report to my regional manager. So it makes it kind of complex, but it doesn't mean that it is not attainable. So many organizations use it. So I will not dwell so much on this because we have touched it before now. Core functional areas, you have a production, people that would create goods and services, marketing, people that would advertise, they'll bring in sales, they'll go and tell people, this is what we are doing. And administration, there's the basic support services that we need, human resource, recruiting, training, then finance people, people that will manage funds. So I said it before that a business cannot succeed without effectively managing its core functions because they are interconnected. For all of this that we are seeing here now, for the production, for the marketing, for the finance, just imagine that one of them now begins to feel like I am more superior to this. Of course, I know that there's hierarchy, but it doesn't mean that one of them is way better. So we need to eradicate that mindset that this particular department or this function is better than the other. Because by the time you begin to say that human resource is better off than marketing, you begin to see that there's going to be lapses. The truth is, the human resource is very important, but the human resource department cannot take the place of the marketing department. So they are all interconnected. And that's why we need to effectively manage all these core functions properly. But we will not dwell so much on that. The finance function, they need to strong financial management. They need to manage the finances of the business, sustainable growth, and also be accountable. Then human resource, we have spoken about that. Production function, people that are in charge of producing, turning our input into finished products. Marketing, we have said that. So we are going to quickly look at, okay, let me see how much more we can do. Okay, I know that we'll be going on break by 12, but let's quickly run through the role of government in business. Yes, I said earlier on when we looked at business environment, we talked about the internal factors and external factors. And I said that internal factors are the factors that are within the confines of our control. We can control them, but the external factors, we cannot control them. You can't exert control over them. All you can do is what? Manage them. Manage them to be able to do what? Achieve your desired goals. Now, what is the government role in business? Government is one of the external forces, one of the external factors of a business. So for every business, they will usually know that the government have a role. Government plays a very significant role in the success of every business. So now, how do you manage it? Government significantly influences the business environment through regulation. Oh, this regulation support and enforcement. It creates the legal framework within which business operates, ensuring fairness, safety, and accountability. Let's look at some of the roles of government in business. Regulation and licensing, very, very important. So government regulates business. Government will set standard that every business needs to meet. Government establishes requirements for business registration. You need to register your business with CAC. That's a regulation. Operating licenses, some of the licenses that you need to, depending on the kind of business you're running, for mostly all these business consulting, for all this consulting business, There are some licenses that you need to get. You have to get your PENCOM, you have to get your SCOM, so all these are regulations. And so if you don't get them, the government will be after you. They have a role in the business. So again, like I said, you just have to be able to do or manage them, manage the regulation, follow it, get the necessary license that you need to get, especially when it has to do with your specific industry. And you also have to do what maintain the standards. And that's the role of government in a business. The next one is taxation and revenue through the FIRS. That's our Federal Inland Revenue Service. That's another role of government. They will come after you. You need to pay your tax. You need to pay your tax. You need to pay all the taxes that are due from every business. Government collect taxes that fund public services while using tax policies. Yes. So they use tax policies more like just like this new tax policy, new tax law that is effective January 1st in Nigeria to encourage or discourage certain business activities. So for taxation now, if a business is import based, so the business is an importation business, the company runs importation, and the government comes up with a new policy and says that we need to discourage importation. We want to encourage exportation. We want to encourage our indigenous company. We want them to be able to do what? Produce. So you see that that's a rule. Indirect, not even indirectly this time around, directly, that policy is going to affect that business. So you cannot be in business and say that the government does not, you are not concerned with the government. It's not possible. It's not possible. So because they have greater control, so much control over business. Infrastructure provision, they provide water supply, security, a lot of all these things that help the business. Yeah, so electricity is very important for every business. And what happens is the government role to provide all of these things for us. If we have electricity in place, then you know that half of the problem of a business is solved. Not like the provision of the electricity is there and the tariff is unreasonably high. Again, that's still the government's role in business. So you need to understand them. You need to know them. You need to know the kind of role that the government plays in your business, in your industry, for you to be able to thrive in your business. Consumer protection. Government protects consumers from exploitation, false advertising, unsafe products. So these are government roles. That's why we have NAFDAC that would go around to ensure that whatever we are consuming is healthy and is not detrimental to our health. And also ensure that business practices are fair, maintaining trust in the marketplace. So now I've already spoken about them. Yes, so these are key Nigerian government agencies that exert a form of influence over businesses in Nigeria. So regardless of the business that you run in Nigeria, you have a dealing to do with either of them or even all of them. Okay, maybe not all, but either of them. And the first on the list is the CAC. You need to get your business name, even for your sole proprietorship, that will say that I'm not a limited company, but I just want to register my business name. You see that the government also does have influence over them. The CAC, the Standard Organization of Nigeria, ensures quality standards. Yes, even not just for goods alone, even for services. NAFDAC has to do with consumables. Yes, then FIRS. So these are key Nigerian government agencies. Then international organizations supporting business. Apart from the Nigerian government, we also have international organizations that support businesses. You have your IMF, International Monetary Fund. They provide financial assistance to countries facing economic challenges. Oh, yeah. So for countries that are facing downturn in their economy, or yes, so what they do is they offer policy advice, they promote international monetary cooperation, and also encourage exchange rate stability. That's for the IMF. Then the World Bank They fund development projects. Yes, most especially when it has to do with education, healthcare, and agriculture. So international organizations indirectly or directly support businesses in our countries. You have your World Trade Organization. So they promote free and fair international trade. They want to reduce barrier to global commerce. They want to reduce it drastically. So it's not just that there will now be a barrier to who and who you can trade with. That's one of the roles that the World Trade Organization um, perform. They want to reduce it. They actually go a long way in resolving trade disputes too between nations. Then our dearest ECOWAS, for us that are in African countries, economic of West African states, they promote regional that has to do with the West Africa economic integration. So for ECOWAS, they would usually would limit trade barriers between West African countries. They want to encourage Nigeria to trade with Chad or probably Benin Republic, so Western African states. So these are international organizations that are supporting businesses. This international body shape national business environments by providing funds, we set standards, very important. So you cannot measure performance if there's no stipulated standard. So what performance are you measuring? It has to be, you are using your standard that has already been set to measure. Okay, we want to measure how well you have done in accordance with the standards that have already been set. Facilitating trade, their impact strengthens local businesses actually. It does. International organizations supporting business. So we want to run through. We have less than 8 minutes. So small scale industries in Nigeria, small scale industries are businesses with limited capital investment, yes, and small workforce, typically employing fewer people, less than 50 people, yes, less than 50 people. That's what make up the small scale industries. They form the backbone of Nigerian economy. Regardless of their size, they're actually the backbone. And so that's why you would always see some funding project for what they call SMEs, small medium enterprises. So those are, because they are actually very important in an efficient economy. Common examples, you have tailoring and fashion designing, catering, food, processing, all these are common examples. And they play a very, very vital role. They play a very vital role. In community development, they also encourage youth development, youth employment. They reduce poverty very well. So if we have a more number of small scale industries in Nigeria, what it means is that poverty is being reduced at a very significant rate. Then local production too. Just like I said when I was talking about government influence over businesses. So if they want to limit importation, we'll fall back to small scale industries who have been involved in local production before time. So yes, while small businesses matters, you can see they are very important, very, very important. 96% of Nigerian businesses, they are very important, so we cannot do without them. 84% employment share, they employ people. Then 48% GDP contribution. So this is what statistics are showing us. And very important because small businesses matters a lot, a lot. See some of their contribution. They've reduced poverty. I talked about that. Then also increase local production and reduce importation. I think that's one of the reasons why government will just come up with some policies to do what? To reduce importation and to do what? Encourage local production. Specialized forms of businesses. So, yes. Forms of business, we've talked about the three primary ones. Let's quickly run through the specialized form. So beyond the traditional sole proprietorship and limited companies, we have cooperatives. They'll come together, pool funds together, and say, okay, we have needs. let's come together. I might not be able to fund it alone. Let's come together and just pull our resources together for a sole aim of meeting a specific needs. So yes, a one-on-one member, one vote. Okay. Nigeria examples of cooperatives. We have for even government schools, they have cooperatives. Those government employees, the public servants, at the end of the month, they have a cooperative where they will just be contributing a little amount of money. At the end of the year now, Christmas is much approaching. What they will do is they will just pool their resources together and they will go and get products, food items, food supplies at a very great. That's just what cooperative is all about. Your village savings, this ajo that people do, where they will do ajo and they will say, okay, this person will take first, this person will take second, this person will take. It's a specialized form too. So people come together to do what? To promote mutual financial support. Farmers cooperative, transport unions, then market traders. We have cooperatives of market traders, group of traders organizing to improve market conditions. They facilitate bulk buying. We spoke about that. They gather together, they come together and they say, we want to buy, but we might not be able to buy, I might not be able to buy so much. Even one of the things that happen with cooperative is that it encourages economies of scale. So when I'm buying more, I am entitled to discount. So I can now buy more even with the money. Now I have 1,000 naira. If I want to buy 1,000 naira worth of goods by myself, it cannot be compared to when I am adding up or joining with other people that have 1,000, 1,000, 1,000. Then we come up with say 50,000, and we take that 50,000 to go and buy goods. So there's always economies of scale, and that's one of the reasons for specialized forms of business cooperatives. Then we have joint venture. Joint venture is a strategic alliance where two or more independent businesses or individuals agree to combine resources for a specific project. So they have come together, they have goal, a specific one. It's not like it's going to be it's not going to be something that has to run for more like a going concern. No, joint venture is they have a specific project. It could be a new business, it could be for a defined period of time. So they will share ownership, they will share the risk, the cost, and even profit related. Joint ventures are frequently utilized for market entry. You want to enter into the market, you want to penetrate a new market penetration. You are trying to penetrate into a new market, and you just look at it and say, if I'm going as a sole proprietor, it might not work. Can I come together? Let's join forces with other independent business or individuals so that we can combine our resources together and we can get a very significant market share. Now let's look at illustrative scenarios. Two friends might make their expertise, one as a culinary expert, the other in business management. And they look at it and say, let's open a restaurant. You'll be the one to be doing the technical aspects. You'll be the one to be doing all the cooking, ensure that the food meets standard, while I will be the one to manage the business. That's a joint venture. It could also happen in a construction company. So you come together and you pull resources together to do what? To enjoy economies of scale. Now, I know that we have just 2 minutes before we go on break. I just want us to look at this question. Which form of business do you think is best suited for Nigeria today and why? If you are in Nigeria, from all the forms of business that we have spoke about, I believe that you should be able to tell us one of them that you feel like, okay, because of the kind of environment that we run in Nigeria, this kind of business is very good in this country. So please, can you unmute and speak? So there's no right or wrong answer. You are the one that is looking at it, because for every form of business that we have spoken about now, they have advantage and they have disadvantage. So please, which form of business do you think is the best in a typical Nigeria environment? Yes. So please, the floor is open before we go on break. Very good. I'm waiting. almost 12 p.m. already, so that we can be sure that I've been communicating so far. So please, which form of business do you think is best suited for the kind of economy that we have in Nigeria today?
Can you hear me? Thank you.
Oh, I can hear you now.
Yes, yes. For me, I believe it's cooperative
Okay.
because it has to be able to meet your immediate needs with the little
Mhm.
resources you have, even though you are not
Mhm.
be concerned about other challenges that encompass businesses in Nigeria. But if there is more finance to be able to move the business forward, I can also prefer joint ventures.
Okay. Okay. Thank you very much. Thank you, Mr. Omo. Thank you. Please, any other person, which form of business do you think is best suited for Nigeria and why? Please, 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 let's contribute. So, I'm waiting. Thank you, Mr. Omo. Can we have other people just unmute and talk? The kind of business that you think is perfect for the kind of economy that we have in Nigeria today. Just one or two more persons, and we'll go on our short break. Okay. So you can actually use the chat room if you don't want to unmute, but it's fine. I think it's time for us to go on our short break. So, is anybody going to answer? Is anybody going to contribute to this question? Form of business that you think is best suited for Nigeria today? If I can start calling names. Okay, so if there's no longer any, if I will be getting more responses, then I'll just hand over to Mercy at this point. Mercy, please, you can continue. I know we are going on break by 12 p.m.
Okay. Yes, ma'am. Is any question? Okay. So in the absence of no question, in the absence of no question, I think we should go for a short break. We'll be
Okay.
back at exactly 12:30 p.m. Nigerian. Please don't go too far. Thank you so much, ma. We'll see you by 12:30 p.m.
All right. Thank you very much, Mercy. you very much. Thank you, and I hope we had even though the break was short, I hope we had a wonderful break. Okay, so maybe for the sake of people that are just joining us, I will just quickly go through the past.
Your voice is actually low.
Oh, really? Is it better?
Yeah.
Is it better?
Yes.
Okay, okay, okay.
Yes, it's okay now.
All right. So far for the last 2 hours, we were able to talk about the primary forms of business ownerships. We also talked about the fundamentals of business, what business is, the business environment, how the government, that is, how the external factors influences businesses. So we talked about sole proprietorship, partnership, and corporations, as well as their types. So just for us to continue, we'll be looking at franchising, a popular trend. This is another form of business ownership, so but these are more specialized. And so franchising, what does it really mean? Franchising offers a unique way for business to expand rapidly and for individuals to start a business with a proven model. So what it means is that this particular kind of business helps an existing business to expand, right? And it also helps individuals to start up a new business, start up a business with a proven model. What do we mean? We are saying that you already have a business that has stood the test of time, a business that has built his name, that has built reputation for itself, a business that is well known, that and the success rate is predominantly high. And what happens is a new business looks at it and say, I don't think I want to go through the stress of starting all over, trying to build a business from scratch. I don't think I am in for that. What do I do? Let me go and start a franchise. And we're going to explain what that means. It's a popular strategy in Nigeria and even globally. So you just walk up to an established company with proven results, and what you do is you pay some amount of money to them. They will give you have access to their name, you have access to their brand model, you have access. So you are going to be operating the business just like the way that the founder of the business will do, all because you don't want to start a new business. So what are you doing? You would have to make a commitment fee. Of course, you have to be paying royalty to the owner of the original owner. It doesn't make you a fake owner, though. The original owner of the business. So you have some amount of money that you have to pay, a percentage from your revenue that you'll be paying to the brand owner. But what happens is that you are able to start up a business with a proven model. So it saves you the stress of starting from scratch. It saves you the stress of thinking. It saves you the stress of trying to advertise your company, trying to make yourself well known, trying to build a reputation for yourself. All that has been sorted. All you need to do is adopt the model that is in place and start up your business wherever you are. So at its core, franchising is a business arrangement where a successful business, that's the franchise or the person who owns it, initially grants an independent entrepreneur or company, the franchisee. The company now is the franchisee, the right to operate a business using the franchisor's established brand, business model, and operational system. In return, the franchisee pays an initial fee and ongoing royalties. So before you can be allowed to take on that business, to start up the business in that name, in that brand, because you know the reality is that a lot of cost has been saved, a lot of cost, the cost of advertising, the cost of marketing, the cost of research and development. Of course, it's not as if you don't need to do all of these things again, but what it means is that your work is half done, very, very half done. So that's why you will now be the one, as a franchisee, will be the one to pay an initial fee and an ongoing royalties. And so the royalties can be discerned or can be determined that, okay, this is a percentage you'll be paying to us out of your revenue. This is how much you are going to be paying to us. Now, from all that I have said, the franchisor is the original business owner. It's the person that owns the business. It's the person that developed the brand. It developed everything, operating procedures, everything. And they also provide support and training to the franchisee. Then the franchisee is an individual or entity buying the right. You are buying the right to operate the franchisor's business. So what happens is that you know that originally let's take for example Chicken Republic. I like the kind of business. It's a food business and all of those things. So I like it. And I cannot just wake up one morning and I want to establish a business and I go and call it Chicken Republic. No, I can be sued. Not like I can be sued. I will be sued. So what happens is if you think that that's the kind of model that you like and you don't even want to go through the stress of building a brand all from scratch, what you need to do is adopt this franchising model. Walk up to them. Of course, you have some conditions, you have some things that you need to put in place, and before you know it, you are free to use the company's name, model, and brand. Okay. So how it works is a symbiotic relationship. So for people that have done biology, so this one is not a parasitic relationship. Yeah, so you know that you have a parasitic where it is just one person that is enjoying, trying to use the word now. So it's not one person that is just getting nutrients or that is just getting enjoyment. No, that's not what a franchising is. It's a symbiotic relationship. The both parties, they all have what? They all have roles to play. They all have successes that they would both earn or achieve at the end of the day. That's what makes franchising a symbiotic relationship. A franchisor is there, he has his role and responsibilities, and at the same time has what he or she would be enjoying. That's the reward at the end of the day, as well as a franchisee. Now, let's look at the roles very quickly before we look at some of the examples, like a typical example that we can find everywhere. It's possible that you don't even know that it's a franchising. I did used to know before. Prior to now, I'll be wondering, I'll say, this, what's his name, Chicken Republic, I think when I was way younger, they have many branches. They really have money. Yes, that's how we were thinking then, until we realized that, oh, there's actually a business model that companies, business adopt just to make life easy for themselves. Now, what are the roles of franchising? That's the original owner of the business. It provides recognized brand. So you have to have done your work. You have to have done a lot, invested a lot into your business before you can now say that you are calling or you want franchisees to come and pay for your business name or trademark. And intellectual property, it offers a proven business system. So it means that this business system that has been adopted by this particular company has been proven, has been tested, and has let's use the word tested and trusted. Yes. So you have to offer a tested and trusted service, a tested and trusted business system. You also have to train. That's the role of a franchise. So you really want to train the franchisee that, okay, this is what it entails for you to successfully run this kind of business that I have. This is what you need to do. This is how it is being done. These are our trade secrets. These are the things that we do, our daily operations. Look at where we source our materials from. Look at our proportion, how we mix our recipes. All of those things are training. So they also supply ongoing support. So the fact that a franchisee comes in and says that I want to have a franchise under your trademark or under your business model, it doesn't mean that you just let them be, probably because you are just collecting your royalties. No. So the franchisor, the original owner of the business, has to do what continually support them. Do you even know why they need to? Because the truth of the matter is, if they just let them do whatever they want to do, they are going to dent the reputation of the business. That's just it. They will dent the reputation of the business. So because they don't want all their work, all the years of their sacrifice, everything they have put into their business to go down the drain, what happens is they continue to supply support, even as you continue, you are being supported along the line. Marketing materials, sometimes even supply chains, access. Oh, how do you even get it? This is how you can do. You are where exactly are you operating from? Who do you think you want to? Who are your targeted or your potential prospects, your customers, your targeted customers? Who are those people that you think that, oh, these people should be part of my business? They should patronize me. So all of these supplies, all of this support is what the franchisor will do for the franchisee. Ensures brand consistency. I just talked about that. You want to be consistent. You don't want someone to come in who doesn't even know how you have labored or the kind of work you have put into, just because they see that the model or the brand is now well known and is thriving, and they just want to do as they please. No, so you have to ensure brand consistency and quality across all franchise locations. All right, so franchisee's role. So you invest capital to set up. Yes, you have to invest capital. And you have to operate the business according to the franchisor standard. So I remember that last month or 2 months ago, this popular store in Nigeria, a supermarket store, I think it's called Boku or something. And somebody was trying to tell the lady that was selling the bread, I was telling her that this bread doesn't taste like the one in Surulere. So the person is in Solo. And she was like, as much as it's the same name of the bread, it's the same name, the same packaging, it doesn't taste exactly the same way the one that they sell in Surulere taste. And that was when the person said it could be franchising error. Do you understand? And that was where I actually picked something from there. So that's another thing that is very dicey about this kind of business model. Now, you as a franchisee, they need to do what? Operate the business in accordance with the franchisor standard. This is the standard we have laid. This is the recipe we have provided. This is how we run our business. This is how we go about our production. So it means that if you are coming into the agreement, you must do what? Follow it according to our standards. That's the role of a franchisee. Then pay initial franchise fee. Yes, you have to pay, and you also have to pay a percentage of your revenue. So the franchisee will manage day-to-day operations, hire staff. You go about your business as if you are the owner, because really you have your own investment in it too. So you are also part of the owners. So you have to ensure that customers are satisfied, because you would not want a situation whereby people begin to say that, oh, this particular franchise is not doing well. I don't like their product. I don't like the way they render their services. You can go to other. So at the end of the day, that's why I already established there is a symbiotic relationship. So whatever the franchisee will do, or whatever the franchisor will do, affects the both of them at the end of the day. So it's not like it's just a one person thing. It's not because I'm now a franchise, it doesn't mean that I don't have to consider other people. That's very important. So it also follows the franchisor's guidelines for products, services, and branding. And one of the goal of the franchisor or the original business owner is that as much as they want their business to expand everywhere, they want, oh, they should be talking about KFC everywhere, they should be talking about my business everywhere, but they want to also ensure that the products, the services, the branding are what? Consistent. Are what? Consistent. So, and that's one of the role of the franchise. Now, let's quickly look at popular franchise examples in Nigeria. Some of the examples, international franchise, you have your KFC, for all of us that go to KFC. So I'm telling you today, there is a franchise. The place that you go, whatever manager you see there is not the original owner of the business. Yes, Domino's Pizza, Subway, Cold Stone Creamy. So the truth is, you look at it and say that if you go to the US or probably the UK, you will still see KFC, you will see Domino Pizza, you will see Cold Stone. You even see ShopRite everywhere, right? So at the end of the day, you just know that, okay, I think this is the kind of business model that they are adopting. Now, let's look at some of our Nigeria success story, our homegrown brand. You have your Chicken Republic. Chicken Republic is a rapidly expanding restaurant. The Place, Tantalizers, Mr. Biggs. So all these are examples of franchising, a popular trend. Okay, so why is franchising trending? I think we have spoken about this already. Proven business model. You already know that it's tested. It's reducing guesswork and risk. Yes. So the risk of the business risk is reduced. The risk of starting a business and failing is reduced drastically. So because of a proven business model, brand recognition, you are just coming into the place and you're enjoying the work of what people have done, right? It's actually a very nice business model. So it gives you immediate customer base and market trust. So people already trust you automatically. You don't have to start and trying to convince them. You don't really have to start. Of course, you still have your role to play. This is not undermining that you still have a lot of things to do. You still have a lot of customer service. There are so many processes that you need to put in place, right? But it's still telling you that despite all of these things that you have to do, your brand is recognized. That is why it is trending. Training and support. You are not left to do it on your own. You get support from your franchisor or franchisee. Then lower risk. We already spoke about that. The risk is lowered, like very, very low, very low. Then access to established supply chains. So the franchisor would give you connections, will give you access to their own supplier because they don't want you to get something that will alter what they have been doing, that is going to be different from what they have put in place. Often securing better pricing and consistent quality for goods. Consistent quality for goods. All right. So benefit for both sides. What do they stand to gain? Franchising provides a win-win scenario. That was why I explained symbiotic relationship. I said this particular kind of business model is not a parasitic. It's not that kind of parasitic relationship that we were taught in biology. No, that's not it here. So it has to do with a win-win. This person is winning and the other person is also winning. So for the franchisor, you have rapid expansion. You are quick to, before you know it, you increase your market share. You increase you increase your market share in the global markets. Just take, for example, KFC now, originally is an international franchise in business, and they are everywhere in Nigeria, not just in Nigeria, West African countries. For every country you go, you will definitely find it there. So it's also rapid expansion, reduced capital investment. So the original business owner do not have to go through the pain of establishing. Do you know what it's going to cost them to say that I want to come to Nigeria to establish a business? I want to go to Ghana to establish a business. I want to go to South Africa to establish a business. Okay, now that's even far-fetched. Let's even look at this our Chicken Republic. Just imagine what is going to require of the owner of Chicken Republic. We have, I can't, of course, I don't even know the number of Chicken Republic we have in Lagos, let alone other states. Now, imagine the capital requirements. It's a capital intensive project, very, very capital intensive project. And so what does franchising do? It helps you to reduce your capital investment. So there's less financial burden, trying to think of how do I open this company in this branch? How do I open this company in that branch? No, no, no. So that is helped. Helped over there. Motivated operators, franchisees are invested owners, often leading to better performance. Yes, they are always motivated. Increased brand presence, widespread visibility, so everybody knows about your company, and local market penetration. You're able to penetrate the market easily wherever you find yourself, wherever your business is situated or is operating from, is able to do what? Penetrate the market easily. Then from the franchisee, you have reduced risk. We've talked about that. Brand equity, you benefit from immediate customer recognition. Then comprehensive support. This cannot be overemphasized. Then easier financing. Lenders may be willing to finance, yes, a franchise with a strong history. That's right. So you can get loan easily because if you go to a bank or you go to a lender, you want to borrow loan, and people will ask you what you want to use the loan for. You say you want to establish a franchise, and you call one name that is not even that is not so known, the skepticism in approving the loan will be there. But if you are going there, you're saying that I want to establish a franchise, and then the is a well-known brand like Domino Pizza, and so they will look at the trend and say that, oh, this business has actually been successful over the years. Then I think it's a good venture. We'll be glad to offer you the loan. So these are benefit for the franchisees. Then challenges and considerations. Whatever has advantage has disadvantage. While it is beneficial, it doesn't come completely without complexities. Both parties should be aware of potential challenge. So strict adherence to rules. So franchisee. So there is nothing like I this is how I used to do it. This is how I want to do it. I and you now come up with, I think we need to be innovative and begin to try to alter or begin to try to modify what was given to you. No, it's a challenge here. So you need to follow the rule. So it limits creativity though. So when you adopt this kind of business, you are trying to put in a lot of structures that you think is going to be beneficial because of your environment too. And you are trying to put all of these things, you are trying to be creative in managing the business. But the rule is saying that no, you have to follow it. Is rigid, it's not flexible. Yes, that's the word. It's not flexible at all. So it's very rigid and it has to be what strictly adhered to. Initial investment and ongoing phase. Significant upfront cost. Yeah, you have to pay a lot of money upfront, and continuous royalties can impact profitability, especially in the early stage. Yes, so you might not be able to account for so much profit at the early stage because look at the kind of cost that you have to bear at the beginning of the business, at the early stages of the business. Yes, so these are challenges. Then interdependence, the success of one franchise can affect the entire brand. I spoke about that earlier. So it can affect. So you won't just wake up one morning and say that this is how I want to do. Once people, let's even take a very practical example, for Chicken Republic now. If a Chicken Republic branch close to my place now, I go there to get something, let's say maybe meat pie or whatever I went there to get, and the customer service delivery was poor. I was offended. I didn't like the way they attended to me. Do you know what will happen is that when I go to another place and I seek Chicken Republic, the experience I had with the one in Lagos is the same one. So you see that it's interdependent. You just see all of them as they are one. There's no, of course, because they are using the same brand name and everything. So that's actually a challenge. And that's why whatever decision or whatever actions that one franchise take, it must be aware that it is indirectly or directly affecting other brand. So market saturation, over franchising in a specific area can lead to competition. Yeah. So exactly, competition among the franchising of the. So because we are of the same brand, it doesn't make sense that we now begin to compete amongst ourselves. It's just like the place is in Ikeja, Allen, is another one is in the bus stop very close, and before you know it, they begin to compete among one another. That's the disadvantage of market saturation. Yes, long-term contract, franchise agreements are typically long-term, requiring a significant commitment from the franchisee. Is a long-term contract. So the question is, are you willing to go through that route? Are you willing to do that long term? When we're talking about long term now, we're not looking at 3, 4, 5 years. You're looking at something that is going to stand number of years. So that's another challenge here. So we will run quickly mergers and acquisition. So what is merger? Merger, of course, when two or more companies combine to form a single or new entity. So you have two companies or even more two companies or more, they just look at it and they say, okay, I think we should be able to form a single company. And they come together and they form one entity. The original company ceases to exist independently. So if this one was existing before, what happened is that all that is gone. They now become what? Become one company. A new company is created, often with a new name, most times a new name. So yes, that's what a merger is. But an acquisition is what happens when acquisition is done is that a company purchases another company, it takes full ownership. It acquires the company completely. So, and the acquiring company usually retains its own name. So let's assume that we have examples of acquisitions. So let's assume that Access Bank, yes, just the way the Access Bank acquired Diamond Bank, a very typical example. We used to have Diamond Bank before an Access Bank. And so Access Bank acquired Diamond Bank. But what happened? The name did not change. The person who the acquiring company did not now change and say that let's start modifying the name. His name still is what? Access Bank. So that's the difference between merger and acquisition. So for merger, we have horizontal, vertical, and conglomerate. So horizontal is the same stage of production combined. So you have two competing soft drink manufacturers merging together. Let's take, for example, Coke and Pepsi come together to do what? To merge. That's horizontal merger because they are in the same industry. Then vertical and at the same stage of production. Then vertical is that either a supplier or a distributor, they might be in the same business, but not the same stage. Now, a car manufacturer acquiring a tire company. So you know that a car company also needs tire for its production. And so it comes down and does what? Acquires a tire company. That's a vertical merger. But for conglomerate merger, they are not even in the same industry, unrelated completely. So you would say that probably a car manufacturing industry now goes and acquires a soft drink producing country. That's a conglomerate merger. They merge together, not acquire now. They combine together to make one company. Why do companies pursue merger and acquisition? Market expansion. They want to be able to do what? Expand their market. They want to gain access to new geographical markets. So cost saving, synergies is actually very cost saving. The cost of operating and you're not getting return. Why not just merge or probably get acquired so that all these costs can be avoided? Then access to new technology or expertise. Acquire innovative technologies, patent or specialized. So yes, you have access to new technology. For mergers, you have a company that is coming. What if the company that is coming together to combine together with yours already have a sophisticated technological expertise? What happens is that automatically it rubs off on the other companies that came together to merge. Same thing with acquisition. For a company that is acquiring the other company, at the end of the day, all of them still have access to new technology. Then eliminate competition. Rather than competing, just like in Diamond and Access Bank that I used as an example, it could be that yes, even before Access Bank acquired Diamond Bank. Diamond Bank would have been seen Access Bank as a competitor. Of course, the fact that they are in the same line of business does not mean that they are not trying to get customers, right? But what happens with merger and acquisition is that it eliminates that competition. Now they begin to see themselves as what? One. That's it. Acquire a rival to reduce competitive pressure. The pressure to always compete and need to, like it reduces your competitor. Yeah, so that's just what it is. Okay, so I think we have done this. Let's just quickly run through in a few minutes. Advantages and disadvantages. Whatever has advantage has disadvantage. And some advantages of this is that economies of scale. You are able to, at a lower cost, you're able to increase production. At a lower cost, you're able to acquire more products. You are able to acquire more goods, right? So that's economies of scale. That's an advantage. Better bargaining power with suppliers, yes. So increased market share, we said that already. Diversification, it spread risks across different products, especially for conglomerate merger, release reliance on a single stream of revenue. Then access to new markets. It helps you to be able to do what? Penetrate markets easily and quickly. It also helps to reduce costs. It reduces costs. It reduces costs. So they're able to come together and use their resources very well by doing what? By streamlining the processes. They are cutting down on some things that are not necessary. Why? And at the end of the day, they end up doing what? Reducing costs and increasing profitability. What are the disadvantages? Cultural clashes, different corporate culture. It could be that in Diamond Bank and Access Bank, by the time before they got acquired, Diamond Bank would have their dress code, their uniforms that they use, right? Their cultural, their corporate culture. This is how we do it. And at the end of the day, by the time they get acquired, you begin to see that, especially if some of the staff of the other company that was acquired was not laid off, probably they were able to just take all of them. You begin to see that we're not used to this kind of method. This is how, excuse me, this is how we have always been doing it. Then it could lead to job losses. Exactly. So if the new company, if the acquisition or probably the merger is not able to cater for all the employees, what happens is that jobs are lost. Then are lost. Integration challenges, merging IT system, trying to merge a lot of systems. The operation can be complex and costly. That's right. Then high cost, no. Merger is actually very costly. Acquisition premiums, legal fees and integration expenses can be substantial. Regulatory issues. Merger often requires approval from, yes, you cannot just wake up one day and say that you want to go and merge with another company, regardless of your strong reasons. So you need approval from regulatory bodies. Yes, and it could also face delay or prohibitions if competition concerns are raised. Okay, so we are almost here. And current trends in business ownership, understanding generational shift is crucial. So you need to understand that there's a generational impact. The way our fathers would take business ownership is not the same way this new generation, the Gen Zs or even the millennials are also doing it, right? Let's now look at some of the generational impact on franchise trade. So you have the baby boomers. We're talking about generation now. We're talking about gap, the age gap or the generational gap. Yes, for people that were born 1946 to 1964, their current age will be around 70, 60 to 78 years. Baby boomers, as this generation ages, their demand for tailored services drive growth in specific franchise sectors. Example, health club for seniors. So for the aging generation, what happened is that the demand for tailored services, like just something that is specific, they are not asking for a general. So whatever it is they are requiring or whatever it is that they need has to be tailored to their own specific needs. The millennials born 1981 to 1996, their entrepreneurial spirit and lifestyle preferences are reshaping the business landscape. Yeah, it's actually that's where you have your remotes, your fast and casual restaurants, technological driven services, co-working space. Before now, our I'm trying not to say our parents or our forefathers now because they are not very old. So the generation, that's the baby boomers generation now, they didn't really adopt, they didn't really know what it means to come together for co-working space or probably technology driven services. So what happened is that this is a trend. The fact that this is not what was prevalent or what was evident at this age. What happened is that you begin to see that there's a shift in trend. There's a shift in trend. The next generation now, what will happen is that their own work culture or their own current trend in business ownership is also going to take a dynamic shape. That's just what we mean by current trend in ownership, business ownership. So redefining retirement. So the baby boomers generation, they are altering traditional retirement path, often delaying full retirement. So yes, and you agree with me that for some persons that have their parents who were maybe principals, public servants that are retired, 60 years retired, they will still look for something to do. They will not just go and sit down. So they're also doing what they're leveraging their extensive experiences to launch new businesses. Like this one is so pronounced. After they are retired, you see them going for more. They are still productive. They don't just go back and go and sit down and say that that's the end. So that's the retirement trend in business. Global merger and acquisition trend. Corporate America and global enterprises have initiated a new wave. So there's a new wave now. Renewed activity, a significant increase in corporate transaction. The new market entrants. People are able to do what's coming to the technology firms, the private equity, and the likes. So this has heightened merger and acquisition environment. Present both growth opportunities and potential exit strategies for business owners while also intensifying market competition. So these are trends. This is where we are currently with the trends in business, forms of business ownership, and that will bring us to almost to the end of today's session. And so before we call it a day, do we have any questions? Do we have any questions concerning all that has been said so far? Thank you very much while we wait for your questions. Yes, so it's time we want to take questions and even contributions. So you also want to tell us, is there something that you have learned? Does it look like those 2 hours of your time is quite 2.5 hours of your time? Is it actually worth it? What are the lessons that we have gotten? And please, let's just unmute and speak, please. Thank you very much.
Thank you very much. Can I speak?
Yes, you can, sir.
Oh, thank you very much. I want to really appreciate you for the lecture. From the beginning to the ending, it was 100. It was 100.
Wow.
And for me, I would have had contributions, but all the contributions were made under your. So it's a question I needed to just ask because I really enjoyed the part when you were talking about franchising because it has to reduce the stress, things of regulations, your general registrations, and all other areas you have to go through at the initial phase. But for me, how can we be able to build trust between? My question now is that how can we be able to build trust when embarking on franchising with a friend? For example, it's a form of partnership though, but franchising another way. Let's say I own a business and a friend wants to own a second branch and also be able to put in more capital on the main business, which is coming from my end. But the second branch solely belongs to him. How can we be able to build? You understand what I'm trying to explain?
Yes, I do. I do.
Yeah. How can we be able to build that kind of trust so that our business can be able to stand, which is one, and our friendship can also be able to stand? Because if there is lack of trust in terms of transparency from my end, which he has invested on my own business, but I am the sole owner of the name he's using, then it will have to be able to destroy our friendship. So how can I be able to build that kind of trust to make sure both ends go simultaneously? Thank you.
All right, thank you very much for that question. So I would say that for you to be able to build trust, open communication cannot be displaced. So before the fact that there's a relationship that is already existing is a very dicey situation. So if you recall when we were talking about partnership with spouse or family members, so it means that all of these things have to be spelled out. Open communication. You need to discuss expectations. You need to discuss roles and responsibilities. Like you have to set clear goals and obligations. It has to be set, clearly spelled. Because the truth is, at the end of the day, because there's a relationship there, you might not be able to call a spade a spade. You At the end of the day, you don't want to hurt the feeling of your friend. You don't want to ruin relationship. But by the time we get to the point as human beings, as adults, that we know that business is business, like you have to get to the point where you separate relationship from business. And that's why you have to go through the due processes. So the fact that there's a relationship there doesn't mean that the necessary requirements or the necessary registration, the necessary processes are neglected. So first off, I will say that there has to be open communication. Do you think that this person is someone that you want to trust with your brand name? There has to be clear communication. What happens if at the end of 6 months I'm not getting the desired result? Is there an option, or is there a contract that says that I can withdraw my brand name from you? I think that's one of the things that we need to even start from. Then you also have to regularly conduct due diligence regularly. First off, the part that I said open communication, I think is very, very key. All of these things has to be clearly stated before we even start up the franchising. Now, because he's my friend, I might not be able to, I wouldn't want to start feeling like I don't trust him or he's not being transparent enough. For humans, when we are dealing with humans, you just have to put sentiment aside. So for you to be able to build trust, it means that all that is needed to put in place has been put in place. Open communication, contract, everything is clearly stated. Your contract, how do you intend to go about it? I said earlier in franchising is that one of the rules that guide franchising is that you cannot deviate from, it's rigid, it's very rigid. So the person has to be able to commit him or herself to it. So it's not something that you take it on and you say you want to adjust or you want to modify. So the open communication is very, very important, as well as you need to defend your terms. You also need to conduct your due diligence. I don't know if I answered your question correctly, sir. So please just let me know if that was.
Yes, yes, yes. Thank you.
Thank you very much, sir. Do we have any other question? Okay. In absence of more questions, I'll be handing over to Messi. Thank you very much, everyone. Thank you. Messi, over to you. She'll be cool.
Thank you so much, ma'am. Please.
Not sure I can hear you. Is it just me? Can we hear her?
We can't hear.
Forms of. Oh, someone saying something.
Yeah, we lost you at some point.
Oh, so sorry. I think that's network.
Okay.
All right. I said, thank you so much for an excellent delivery of today's class. I enjoy every bit of it, and I believe that every other person's did same too, from the very beginning up till now. So please, a round of applause to her. And I also believe that it wasn't a waste of time for you. Thank you so pretty beauty. I believe it wasn't a waste of time to any one of us, because today's class was actually insightful. Thank you so much, ma'am. More insights to you. So we have just few announcements. There is a feedback form link in the chat room. Please, as usual, we indulge you to help us give your honest feedback concerning today's training. Please, once you are done with that, kindly type done in the chat room. Please, that's not going to take time, because we are already done with today's class. We just need to hear your feedback so we know how to improve more. So that we can improve more on our delivery. And then second, that has been ongoing for those of us who joined led test has been ongoing. We started on Monday. So if you are yet to write any of those tests, it is still open. The link has not yet been disabled. So please do well to do your test as at when due. By coming from next week, the link for this week is going to be disabled. So please, we are imploring you now to write your test if you have missed any one of them. Because come next week, we'll be having another set of tests, and we are going to disable the link for this week's test. All right. I think that's all. Then immediately after now, the material is going to be shared on your platform. And then the recording of this session too is going to be shared with you by next week, as usual. So whatever, if there is any other announcement, is going to be sent to the group as well. Thank you so much. Please follow us on all of our social media. And is someone raising up a hand? Please go ahead, ask your question.
Thank you very much, Menti. My question is this. I want to know, because from the timetable, I was seeing that programs end by December 3rd, and we're doing tests. But from your previous statement, I was hearing test is not exam, it's part of our requirement for getting certificate. So I just needed to get a clarity on when classes are ending, we're supposed to write our exams, and when we're supposed to get our certificate as well.
All right. So at the moment, we are just doing tests. And part of the criteria to graduate is you must also do your test, you do your exams. As a matter of fact, if you look at your curriculum, we are still doing training, we are still doing lectures, right? So, but we don't want it to pile up, which is why we are just starting tests. So by next year, by God's special grace, we should be commencing our exams. But for now, we are writing tests. Once the exams timetable is out, it's going to be sent to your different groups. I don't know if I have answered your question.
Yes, you have. Thank you very much.
All right. Thank you so much for that. So please follow us on all of our social media handles, Facebook, Instagram, LinkedIn, Twitter. Subscribe to our YouTube channel, and we need a lot of your engagement. Thank you so much. Please, I want to believe that we have filled our attendance as well as the feedback forms. Thank you so much. And from here, I would say have a very wonderful weekend, and we will see again in the next class. Bye.